Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ZTE Corporation Annual Report. ZTE Corporation is a leading provider of integrated information and communication technology solutions globally. The company operates through three main segments: Carriers Networks, Consumer Business, and Government and Corporate Business. The Carriers Network segment offers a wide range of products and services, including wireless and wireline access, bearer systems, core networks, server and storage, and other technologies. This segment caters to the needs of telecommunications carriers worldwide. In addition to its carrier-focused business, ZTE also has a significant presence in the consumer market through its Consumer Business segment. This segment develops, produces, and sells home information terminals, smartphones, mobile internet terminals, and fusion terminals, as well as provides related software applications and value-added services. The Government and Corporate Business segment is another key area of focus for ZTE, offering informatization solutions to governments and corporations worldwide. The company leverages its expertise in communications networks, IoT, big data, and cloud computing to provide tailored solutions that meet the specific needs of these clients. Overall, ZTE Corporation provides a diverse range of businesses and services across three main segments, catering to both individual consumers and large-scale organizations. ZTE Corporation market capitalization of $155 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that ZTE Corporation holds a significant advantage in their industry. ZTE Corporation trades at a lower price-to-earnings ratio of 17 times and a lower price-to-book ratio of 1.23 times relative within the industry. This makes the stock valued slightly lower than its peers in the industry. This likely suggests that investors are less interested about the company, or it could be that the stock have not caught up to the industry valuation and should further be investigated. The leverage on the balance sheet appears elevated, with liabilities of 65% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 3.04%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline can be identified by examining the provided extract. Revenue growth was driven primarily by the telecommunications system contracts with customers, which increased by 14.2%, as well as the sale of products, which rose by 10.5%. The principal business revenue also saw a significant increase of 10.3%. On the other hand, revenue decline was largely attributed to the sales of commodity equipment, which declined from 2024 to 2025. Additionally, the provision of service revenue decreased by 7.1%, and one major customer's revenue decreased by -18.2%. However, it is worth noting that some geographic regions such as Asia, excluding the PRC, saw a significant growth of 16.3%. The extract also highlights the importance of regional markets in driving revenue growth. The PRC, Asia, excluding the PRC, Africa and Europe, America and Oceania all experience growth rates ranging from 7.6% to 16.3%. Overall, these findings suggest that the company's revenue growth is driven by a combination of strong performance in key business segments and geographic regions. The net income and profit margins of a company underwent significant changes between 2024 and 2025. Initially, the net income increased by 35% in 2025 compared to 2024, but this trend was short-lived. The net income actually decreased from RMB 8,355,613 in 2024 to RMB 5,565,073 in 2025, a decline of 33%. Furthermore, the net income also decreased by 50.2% from RMB 6,916,640 in 2024 to RMB 3,446,149 in 2025. The profit margins also experienced fluctuations during this period. The operating profit margin decreased by 2.75 percentage points, from 21.03% to 18.28%. Additionally, the net income margin remained stable at 35% of net profit attributable to holders of ordinary shares in 2025, but the operating profit margin decreased from 52% in 2024 to 54% in 2026. The reasons behind these changes are multifaceted. Industry cycles, technological innovations such as AI and 5G, and government policies all had an impact on the market. The company also underwent a transition of industry cycles and adjustments in its business structure. Furthermore, there was an increase in cost of sales, 23.99%, and a decrease in operating revenue, 10.39%, which contributed to the decline in net income and profit margins. The company's debt level and interest expenses have undergone significant changes between 2024 and 2025. According to the financial reports, there appears to be a discrepancy in the total debt figures reported on different pages. On page 43, it is stated that total debt has increased from RMB 56,538.8 million to RMB 60,214.8 million. However, on page 223, it is reported that total debt has decreased from RMB 100,429,840 to RMB 108,672,717. Despite the inconsistency in the debt figures, there is a clear indication of an increase in interest-bearing liabilities by plus $7,240,474 between 2024 and 2025. Furthermore, interest expenses have increased significantly, with a rise of 6.8% as reported on page 130. This trend is also reflected in the comparison of interest expenses for 2024 and 2025, which shows an increase from 4,368,138 to 5,419,138. The increase in interest expense is not limited to one specific area, as it has been observed across different categories. For instance, on page 186, it is reported that interest expense on lease liabilities has increased by 8.9%. Overall, the data suggests that the company's debt level and interest expenses have undergone significant changes between 2024 and 2025, with a notable increase in interest-bearing liabilities and interest expenses. The company's performance can be analyzed based on the regions and segments that excelled or struggled. On the positive side, the government and carriers network business stood out with revenue of RMB 121,187,877 and segment results of RMB 35,911,212. This indicates a strong presence in this sector. In addition to the government and carriers network business, operating activities also showed improvement in 2025, with an increase in cash inflows from operating activities by RMB 23,435,646 compared to 2024. However, despite these positives, other segments struggled. The consumer business and corporate business both underperformed, with revenue of RMB 32,406,081 and RMB 18,455,069 respectively, and segment results of RMB 4,650,789 and RMB 1,303,614. Furthermore, operating activities in 2025 showed an increase in cash outflows from operating activities by RMB 30,996,744 compared to 2024, indicating a decline in liquidity. The net decrease in cash and cash equivalents in 2025 was RMB 2,544,017, which further highlights the decline in liquidity. Overall, while some segments showed promise, others struggled, indicating areas for improvement. Management is optimistic about the company's future outlook, with a focus on strategic investments and risk management. The company plans to continue purchasing financial products with its unutilized internal funds, indicating a commitment to growth and expansion. To mitigate potential risks, management is actively addressing challenges such as declining 5G investment by carriers and planning for future technologies like 6G. This forward-thinking approach demonstrates the company's ability to adapt to changing market conditions. In terms of risk management, the company aims to reduce the impact of exchange rate and interest rate movements through derivative trading. Management also prioritizes prudent investment in low/medium risk products, focusing on fund security and control of investment risks. The company is committed to responsible innovation, applying AI technologies in a prudent manner while ensuring compliance with regulatory requirements. This approach aligns with the company's goal of becoming a leader in network connectivity and intelligent computing. Overall, management's strategy emphasizes strategic investments, risk management, and responsible innovation, positioning the company for long-term success and growth. The company's financial history reveals a notable trend. On page 45, it is confirmed that the company has indeed paid out dividends to its shareholders. This indicates a commitment to returning value to investors through regular distributions. However, in contrast, there is no evidence of share buybacks on record. The absence of such transactions suggests that the company may be prioritizing other uses for its funds or focusing on growth initiatives rather than repurchasing existing shares. Concerns about inventory buildup or supply chain disruption are evident in the provided summary. On page 123, it is mentioned that there are provisions for impairment of inventories, indicating a potential issue with inventory levels. Furthermore, on page 179, it is stated that raw materials and work-in-progress inventories have a high percentage of provision for impairment, while finished products inventory has a significant increase in provision for impairment. This suggests that the company may be struggling to sell its products or manage its inventory effectively. Additionally, the cost of goods and services increased by RMB 18,586,097 from 2024 to 2025, page 210, which could indicate rising costs and potential supply chain disruptions. The one-year purchase commitments with Zhongxingxin Telecom Company Limited and Shenzhen Digital Intelligence Port Technology Industry Company Limited for raw materials in 2026, page 247, may also contribute to inventory buildup or supply chain disruption if not managed properly. Overall, these points suggest that the company is facing challenges related to inventory management and supply chain disruptions. That concludes the financial summary for ZTE Corporation. Feel free to comment below, and I will be happy to answer them when possible.